It's time for a fun fact. Facebook has lost more value since its all-time high than nearly every company on the S&P 500 is even worth. In today's video, we're going to break down the Facebook stock, and I'm going to give you my intrinsic value of what I think the stock is worth today. I'm also going to break down the chart and go over those levels that you should be looking to buy, and also profit targets that you need to watch out for in the future. So let's jump right in. What's up, guys? Welcome back to This Just In. Thank you so much for joining me today. My name is Justin and I am your host. In today's video, we're going to break down Facebook. It is no longer the top 10 most valuable companies in the world. Last week, they fell out of the top 10 with that massive gap down on earnings. So this could be a huge opportunity to buy Facebook at a discount, one of the biggest companies on the planet. Like I said, guys, that gap down was the largest loss in market cap that any company has ever had in history in one day. Apple previously held that record from 2020, but Facebook just took it over. So quite the drop, guys, and this is putting Facebook in some very interesting levels. So in today's video, I'm going to go over a couple of those reasons why they dropped so much on their earnings report and how I feel about it. I'm also going to give you the discounted free cash flow sheet so you can see what I think the intrinsic value per share is worth. Then I'm also going to go over the chart. So if you want to see me break down those levels that you should be looking to buy and also profit targets that you need to watch out for in the future, definitely stick around till the end so you don't miss that. Real quick, guys, subscribe to the channel if you want to see more videos like this. Remember to like the video so it gets out there to more people. And also come join us at the Patreon if you want to be part of an amazing family and get all of our trade setups. Day One Squad, I love you. Thank you so much for your support. It really does mean so much to me. But let's get started, guys. First thing I want to go over real quick. This is just a chart of all of the different FANG stocks. So Facebook, Amazon, Apple, Google, and Netflix. You can see here over the last 6 months, they've all traded to the downside, but really Facebook and Netflix have been the ones that just got absolutely brutalized. I mean, they got killed, guys. You can see, I believe that is Facebook right there. That is down 48% or 46%. They're the orange line. Netflix is the purple line. They're down about 43%, where the others are only down, 7, 14, which is still quite a lot. However, not nearly as much as Facebook and Netflix. So that is presenting a unique opportunity. Guys, these are the stocks that hold the market up. They literally prop the market up. And so I still think that they have further downside because I think those other ones need to draw down a little bit more as well and kind of balance out. And the index funds are looking pretty scary. But the goal of this video is to figure out what Facebook is worth, if it's a good investment. Should we start dollar cost averaging into it? I already currently have it in my dollar cost average portfolio, and it makes up a pretty large percentage, so I buy it every single week. The couple of reasons why it dropped so much on earnings, guys, was a couple of things. Number one, the Apple iOS privacy thing that, could potentially cost them around $10 billion. But honestly, guys, that was already there in Q4 and Q3. I mean, I don't think that's so much of a total revenue impact. I think that's more of an incremental revenue impact. So when you look at it, it's only like 6 to 7 billion from what I could tell. And I think, again, that's short term. If you have a long-term outlook, I don't think that's that big of an issue. Things like that are always going to happen. You're always going to have those like curveballs that come in. $10 billion is a lot, obviously, but it's not detrimental in my opinion. The second thing was like, a combination of things. It's like TikTok competition. They're spending so much money on the metaverse. The other thing is, like macroeconomic stuff. And then their Reels monetization. Their Reels is kind of like stories. And, that's a big issue, right? Because they're not currently monetized, but they're promoting it and putting a lot of emphasis on it. I just saw something today that they expanded it to like 150 more countries as of today. But guys, it's Facebook. They're always going to find a way to monetize it. And I think once they work that out, they'll be just fine there. TikTok is obviously a big competition, but it's Facebook. Okay, way, way smaller demographic over there on TikTok. when it comes to, overall people, like age and everything like that. Facebook is Facebook. I think that obviously these things are going to affect the stock in the short term, but over the course of the next 3, 4, 5 years, I don't think it's that big of an issue. When I say macroeconomic stuff, I mean, stuff like COVID, guys. These companies grew at such insane, explosive amounts after COVID, and they can't maintain that type of stuff. So the market, is going to see that. They're going to react, very, very emotionally. But over the course, again, of time, that stuff will go away. I mean, they're still projected to grow revenue at a pretty substantial amount over the next, year, 2023. So it's not like their growth is just going to plummet. With that being said, guys, let's jump over to the discounted free cash flow sheet. There is a couple of things that I think could help stop the bleeding. The one is Mark Zuckerberg. He talks tomorrow, and he kind of goes over, some of their investments in the metaverse and what their plans are, and some of their like revolutionary technology in the metaverse. So that could obviously, spark investor interest again and kind of get everybody to calm down. But I think it's just got to run its course. It's got to draw down. It's got to find its bottom. I think the whole market is looking pretty scary right now. The other thing is if they really start to implement a serious share purchasing, system where they start buying back more shares, because they've got more than enough free cash flow to do that. And that would obviously drive, shareholder value, especially when the stock is down this far from its all-time highs. If you take a look at the discounted free cash flow sheet here, you can see right here, guys, when it comes to revenue growth, I only did 10%, which I think is what you should do when it comes to like being conservative, but they're growing at faster than a 10% revenue growth from now, I think, until the next 5 years. They're already projecting to do quite a bit more than 10%. I think they're guiding for about 17%. So 10% revenue growth. And then look what I did at the free cash flow margin. I did 20%, but they are currently doing 33% today. They're a software company, guys. They've got really high margins like that. So the cash flow margin is going to stay up there. It's not just going to drastically drop off. But I put it at 20, which is 13 points off of the 33 they're currently doing, which I think is fairly conservative. And I'm coming up with $247 for an intrinsic value with, in my opinion, very conservative numbers, which is still, well over 20% upside from the current, $202 price point that it's at today. If we change these just a little bit, like look at what it would do if we put it at 30% free cash flow margin, it jumps that share price, that intrinsic value up to $370, guys. If we go back to the 20 and we move the revenue growth up to 15%, $300. And then if we drop down and look at the PE analysis, relative to some of its competitors, like and I even put like some low PE companies in here to bring the average down. Facebook's current PE is like 12. Momo, they're a Chinese social media, 7. Apple, 27. Google, 23. And Twitter, 21. Puts an average at 18. If we don't give them any discount, like we don't say that we think that Facebook should get a larger PE than some of these other companies, it still puts them at $314 for a target PE. So guys, I think any way you slice it, Facebook would literally have to completely derail itself to be worth less than $200 per share as of today. What I'm currently doing, guys, is I'm dollar cost averaging, like I said before. I think you have tremendous upside when you really start looking at Facebook, and I think it's going to continue to fall to pretty substantial lower levels. And so we'll look at the chart and check that out. But guys, just look at this. I mean, $300 a share, if you use 15% revenue growth and 20% cash flow margin, look at what happens if we keep it at 15 and jump to 25 on cash flow margin, 380. If we go to 30 on, cash flow margin, 466 or 456. I mean, come on, guys, come on. Super undervalued in my opinion today. But when it comes to the chart, guys, I mean, we are lower than pre-pandemic levels. I mean, if you go back to right before the COVID crash, guys, I mean, we were 225, 220, and we just broke a major level, guys. That $200 level is insanely important. And I think we are at least going to head down to 173. which if you look right here is that initial high from back in August of 2017. But guys, just, I mean, that $200 level is insanely important. It's a lot easier to see it on the weekly. But I mean, you are going to at least 173 unless you pivot here, spring, and then back test your spring. I mean, you just broke the 200-day moving average on the weekly. That's not good. But take a look, guys. I mean, anything in between 150 and 200 is pretty much straight up, straight down, straight up, straight down, straight up. The first time that it back tested it as support in June 2020 after pandemic, it took off. But it just back tested it as resistance today for the first time since before COVID, guys. I mean, look at this. It drew down, tested the top of the zone, tried to rally, couldn't even go test the bottom of the gap, dumped again, and then tested the bottom of the inflection zone today as resistance and confirmed to market participants a level that was once support is now resistance again. You know, like I said, you could absolutely pivot, spring, back test your spring, and maybe you hold above that level. But I think anything under 207, 205, you're probably going to see 173. And I honestly think you'll see 142 to 150. You know, there's just not enough levels in between that area, except for, again, that one high from back in August of 2017. But dollar cost average, guys, I would love to see this thing hit 150. If it did, I would wait much heavier at those levels, and I would just accumulate and accumulate and accumulate, because eventually it's going to turn around, guys. I mean, it has lost an insane amount of value. If we take our fibs from the COVID crash to the all-time high, I mean, you can see, guys, we haven't even made a 786 yet. Assets that make deep resets, full resets, deep retraces, they usually go 786 and most of the time 886, if not 100% of their value. So that 886 is like right there at like 164, 165. And so it's pretty much, right there at that one, that high from August. So that's where I would be waiting for if you have more of a short-term outlook. If you're dollar cost averaging though, who cares? Love it. Want it to go down further. If you're buying it for the long term and you're not dollar cost averaging, you're just kind of like buying at different levels, then I would personally wait. If you are, bought it, you own shares and you haven't bought it in a while and you want to bring your cost down, why would you buy, right now after, like, what gives you any indication that these are good levels to buy at if you're buying it that way? I have people say all the time in the comments, like, it doesn't matter if you're buying it for the long term. Well, it does matter, guys, because you want to find the most optimal entries. And so unless it pivot, sprung, back tested the spring, and then, started implying that it was going to reverse, why would you not wait until lower prices? And so, take a look here. You had the lowest level of negative momentum you've ever seen in history ever by a large margin. You are waning. You are starting to lose that negative momentum. You had some of the lowest levels of relative strength that you've seen since clear back in 2012. And so, yes, the oscillators are likely to reset themselves. So you may catch a little bit of a reaction. But even if it went all the way back to 218 and tested the top of the zone as resistance again, and then dumped again, it would just make a substantially lower high than the previous high, and it would continue to draw down. So guys, I just think that you want to wait until at least 173. Again, if we jump over to the weekly, it is much, much easier to see, but you just broke some pretty substantial looking levels, guys. Again, a level that was once resistance, 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 then support is now resistance again. So you just got to be careful. Look at your negative momentum on the weekly. Not even starting to wane, guys. I mean, it is insanely low right now. I mean, you've got bearish convergence. It's not looking good, guys. It's looking pretty scary, honestly. Like, this is like recession type stuff where, stocks go into like multi-month, downtrends where they break critical levels of support and they see, insane prices. But this is when money is made. Money is made in bear markets, not in bull markets. Got to remember that. Guys, you want to be the guy that waits for it to bottom out, make a momentum shifting structure, find support, like this, and then this, and then this, and then buy down here, and then distribute your shares up there on all the moon boys that, sold you your shares down here. That's what you want to do. That's what I'm trying to do. So, overall, guys, I think that you will absolutely see $300 again, because as soon as you get back above 218, 220, 218, I'll see you at 293. I mean, really, guys, look, you break 218, you back test it straight up, straight down. And so, I think no problem, you'll see 300 again, and I think you'll see 369 again, but that's your first target, if you're buying it. Really though, if it draws down to 150, obviously your first target after that's 200, but if you get back above it, then your first target after 220 is 300, 293. So that's it for today, guys, though. Let me know what you think about my analysis. Let me know what you think about the price, targets. If you, have any comments, I'd love to hear them. This video is for entertainment purposes only. I'm not a licensed stockbroker. Always do your own research and due diligence. Come join us at the Patreon if you want to be part of a great family. And I'll see you guys in the next one. Peace.